How are you?
Good, yeah.
Good. Good to see you. Look
You
at you with your
too.
little background. How cute.
Yeah, me being as technologically savvy as I am, it was quite the feat putting that together. Thank you.
Yeah, so you asked Carlo or Paul?
No, I don't see them very often.
Oh, pays to have kids.
Yeah, well, Luke is my little technological guy. He actually has built a couple computers and built one for Carlo. I don't know if he probably didn't help Tyler. Tyler's pretty good with the computer.
Paul helped Tyler.
Did he?
Yeah.
They are
But
funny.
they are. God love them.
And so Luca promised to build me a computer, so we bought the parts. It was supposed to be my Father's Day present, but still not done yet.
Working on it for 2022.
Yes, maybe I'll get lucky for Christmas this year.
Yeah, there you go. Only if you can find the chip.
That's right. Apparently, it's like a whole big, as he would say, collusion to keep the prices high.
Yep. All right. Well, we got about 2 minutes left. I think we'll let everybody get in. Rach, how many people do we have on?
Right now we have 8, but people are jumping on, and I'm sure we'll get a few after 11
Okay.
through realtor fashion. Love you all.
You
But
mean 12. You're way early today, girl. It's 12. You said after 11.
oh yeah, a few after 12. I don't know what time it is. I just
It's
do
okay.
a thing.
Yeah.
If I didn't have a calendar, I'd be lost. I'm in central time mentally.
That's okay. As long as you're somewhere mentally.
Hi, Joe. How are
Hello,
you?
Sue. Good. How are you?
I'm really good.
Still
I figured
Okay.
I figured
I
you
was
could
just
teach this
curious,
class,
'cause
Sue.
She just asked me.
No, I'm coming to learn, Joe, from one of the best. So,
I'll try. I figured you knew it all.
no, I don't. Not on your world. I don't. I don't know it all anywhere. So,
Well, the beautiful thing with both of our industries is that it's always changing and keeping us on our toes.
yeah.
All right. Well, it is 12 o'clock and I'm going to be on time. So in non-realtor fashion, I would like you all to meet Joe Marmo. He is with First Merchants Bank. He is here to talk to us about the lending process with builders. And Joe, I'd love to get to tell everybody a little bit about yourself and how long you've been in the mortgage business.
Okay. Well, I don't know how many of you know, but Lisa and I go way back. Our kids went to school together. I actually met Lisa probably a couple of years prior or after entering the industry. I started in 2001, right before 9/11. I'm originally from New Jersey and been in New Albany since 2002. I have 2 boys, 22 and 17. And I ended up in Ohio in the late 80s in the restaurant business, and through sort of not the traditional trajectory, ended up in mortgage banking. And I'll probably be doing this the rest of my life. I was with PNC, which was First National City, and during the mortgage crisis, they merged together at that point in time. 2008, it was the largest merge of like-sized banks. And so for 17 years, I was basically with the same company. I moved over to First Merchants in the beginning of 2019. And I did not make that move I gave it a lot of consideration. And the reason I chose First Merchants, first of all, I've always heard that the smaller banks had, great product mix, lower rates, quicker closing times, which, in our business is very important. And this product that we're going to be talking about today, the construction perm, it's kind of a unique niche that we have. As you may know, not all lenders offer this product, and there are several reasons why. Basically, the risk, considering the length of time it takes to build a home, there's a lot of things that can occur during the process, such as somebody may be qualified at one point, and then maybe at some point they lose their job during the process. Maybe the builder has challenges. But the reason that we're willing to take that risk is we are a portfolio lender, and we handle our P&L. I have a direct line with the president of mortgage that handles the P&L for all of lending for the bank. And, he's just a phone call away, not only on construction, but any challenges that we may have, we can communicate with him very easily. It's a nice feature that you just don't have in the big banks. To get a quick answer on anything may take a little more time. So while you, excuse me? No, sorry about that.
That's okay.
Okay.
So Joe, can I ask you a couple questions?
Please.
So what type of new building financing options do my buyers have? Are we talking they find the land or do you work with the builders? So give me a couple of different options that could potentially play out for our buyers.
Okay. There are typically two different types of financing options. The one that we typically run across, just on a typical residential purchase and on new builds, is referred to as an end loan. So an end loan is just like a typical residential purchase where the builder is actually financing the project from the beginning until the house is completed at the end. That's referred to as end loan. So we're really not involved in that process other than getting the client pre-approved up front. Maybe we submit an application, maybe not. It just really depends on the length of time. So once we have them pre-approved up front, we're basically just waiting to get within 60 days of the house actually being completed. And then we finance the home at that point in time, just like a regular home purchase. We have the traditional closing. We finance the builder after the loan is closed. And typically you have to have the certificate of occupancy. At that point in time, we can close, the house is complete, and then the buyer moves in the house. The other option would be what's referred to as the construction to perm. And this is, a little more complicated, as you may know. And typically what happens there is the buyer may buy the land on their own. They may buy the land with the lot loan. They may buy the land with cash. They may, if they already own the home, maybe they would use the equity in their current home to purchase the land, or at minimum, maybe even use it for the down payment. Or the builder may own the land. And if the builder owns the land, that's usually purchased through the builder under one lump loan, which would be then the construction, the perm loan. And what'll happen? Do you want me to go through that, Lisa? How that works?
Yeah, that would be great if you could give us a timeline from construction to perm loans. Let's say we're going to build with Kevin Knight. I mean, if we're going to build a big one, let's build a big one. And let's say I found the perfect lot in New Albany, and he's not going to buy it. He's going to make me go through this loan process. So take it away.
Okay. So the buyer has a piece of land that they purchased. For this scenario, let's just say they purchased it with cash, just to keep it simple. we can go into the lot loan process later if you want. So let's just say they buy a piece of land for 200,000. And let's say they talk with Mr. Knight and the cost to build is going to be $1 million. Okay. We would then, we typically, some lenders will have higher loan to values. Some have lower. We typically, the sweet spot for us is all in. We want 80% loan to value. Okay. If the loan is lower, let's say under 650, we will make exceptions to only put 15% into the project. But in this case, let's say they own the house, the land for 200,000, and they're going to put, in this case, 20% down. So the first thing that we do is we pre-approve the client, just like they're buying a typical house. We review their financials. We make sure that they're qualified to purchase at the price point that they're wanting to. The next step really is, okay, is Kevin Knight an approved builder with us? So we have a list of builders that once we've worked with, we make sure that they're approved. And we want the soundness of the builder not only protects the bank, but also the client, because you don't want a builder to run out of money during the process and not be able to finish the project. That's just an absolute nightmare. So once the client is pre-approved, and let's say the builder's not approved with us, we can easily get them approved. We had one done very recently on a loan that I had closed in June. And it was basically, he was an engineer, architect with one of the big builders, and he went on his own, and we reviewed his financials and approved him. It was actually very easy. It was actually the first new builder that I approved through this process. So once the client is pre-approved and the builder's approved, we then, the one part that's really different is in order to have the loan approved, we need to know what the end value is going to look like. So what we do is we have the contract that they have with the builder, all the plans, the specification, the cost breakdown, and also builder's risk insurance. And so once we have all that data, we submit it to underwriting. And the critical piece to all of this is the appraisal. What is the house gonna look like? What will the value be once everything is done? And not only do they look at the land value, they look at everything else associated with the build. Right now, what we're seeing though, and I'm sure you've heard this already, the cost to build at these price points is exceeding the appraised values. And you know, in some cases, it's not that big of a deal. In some cases, it could be significant. I had a buyer who approached me several months ago who went through a different lender, and they were building with a custom builder, and the price point was about 2.5 million. They had two appraisals completed. One came in at 1.5 and the other came in at 1.75. All right, so there was a $250,000 difference between the two appraisals, and they both came in $500,000, almost $1 million less than what the house would build for. So what this client did, they ended up coming to me. They worked with the builder and they tweaked the improvements that they were going to do to the house. So it went from 2.5 to about 2.1, just under 2.1 million. And then we had our appraisers come out, and it came in low, but it was only about $150,000 low, where they were able, the client was amenable to that and was able to work with the builder to make that work.
So did the client cover that difference with cash?
The client did, but he was already planning on putting more than 20% down.
Okay.
So if they have a larger down payment, that's basically incorporated into the figure. So the loan to value is actually greater than it would have been initially. Now, if they were only putting 20% down, then they would have to come up with that difference.
Okay.
Okay. So what we do in the scenario that we're talking about with Kevin Knight, so the cost to build is $1 million. the land is at 200,000. So we're working with a $1.2 million purchase price. So we're at least initially going to base the loan off of 1.2 million. So 80% of 1.2 million is 960,000. So in this case, the client is coming up with 240,000 for the down payment. The nice thing is they own the house outright, right? So they already have 200,000 equity for their down payment. So the difference between 200 and 240,000, the amount due at closing is 40,000. So they're going to bring that 40,000 only to closing, plus closing costs, which are in the $7,000 range, where, you know, on a purchase is typically in the $3,000 range. So the closing cost is higher. That's because of the property inspections throughout the process. So that closing cost at each draw. So during the process, I'm getting a little ahead of myself here. So let's say the appraisal comes in just fine, the loan closes, and now they're going to begin the building process. The lender does not want any construction on the property, if at all possible, before we close on the loan, okay? So now we close on the loan, the builder can begin. At closing though, the builder can request up to 10% of the purchase price to start construction. So in this case, 120,000. And so now at the closing, we're going to disperse $120,000 to the builder. Now, the good thing is the client, they're not paying the whole $960,000 in mortgage payments up front. They're only paying on what has been drawn initially. So since they're drawing 120,000, the nice thing also is, remember, the $40,000, that's the borrower's own money. That money's pulled first. I hope I'm not losing you. So we're pulling the 40,000 first from the customer's money, and then $80,000 from the bank.
Okay.
And so now for the first mortgage payment, the customer is paying interest only on $80,000, okay? So that's how the payment works. And to go back to your question, why is the cost so high? So as the construction is progressing and the builder hits, let's just say 20% completion of the property, we then now have the builder request a draw for another 20%. And so we have to send the appraiser out to inspect the property, that confirm that the property is now 20% complete. And then we also have to make sure there are no mechanic liens on the property. And so that's what those extra fees are, the appraisal fees, as well as ensuring that the title is still clear of any liens. And so that will typically happen depending on the builder's request 4, 5, 6 times throughout the process. So at this draw, let's say we give the builder 120,000 again, or 20%, let's call it 200,000. We go through that process and we disperse the funds. The nice thing with us as well is we handle the draw process locally. Okay. So we will actually work with the builder. And if the client wants to be part of that approval process, they will actually have to sign off on that as well to approve the draw. And so now the mortgage has 200,000 plus the initial 80,000. So the client is paying interest on 280. And this goes all the way until the house is complete. And then the loan simply rolls to permanent financing. And then they have their final mortgage for the remaining 30 years. Okay.
Okay.
And it's not a closing at the end. They just sign a couple pages indicating that the loan is approved or that the loan is final.
Okay. So
Does that all make sense?
Yeah, they close at the beginning of the loan and then the draws come out 10, 20, probably 30, 40% as the house is completed. And the buyer then has the ability to approve, as well as the bank, on whether they approve this amount as being, 20% complete or 50% complete, et cetera.
Well, the bill is actually the appraiser that will identify that they agree with the builder.
Okay,
And then the buyer has to agree to allow us to draw the funds to the builder and fulfill their request.
okay. Thanks for
There's a
clarifying.
lot there. Yeah, there's a lot of checks and balances throughout the process. That's for sure.
Yeah, that sounds like it. So, you mentioned something about end loans. What builders would an end loan be, and what builders would qualify for this construction to perm loan? Can you tell us what builders are out there in Columbus? I know Virginia Homes is one of your, we had them on our last series. So if you could talk a little bit more about what types of builders there are in Central Ohio, so we have an idea of who does what.
Okay. So in under the end loan category, you have the builders that are the tract type builders, like MI Homes, Pulte, Ryan, Epcon, and they strictly use end loans. So your client goes to, let's say the MI showroom, they meet with the sales rep, they pick their plan from the few options that they have, depending on the community. They pick their, upgrades and everything to make the house the way they want it within the parameters of the builder, again, such as the MI Pulte. And what happens there in this case is the house is then built, is complete, and then they have the closing at the end of the loan. And the rate is typically what the rate is at the very end. However, some of the tract builders, they can purchase funds that, very early in the process and can actually lock them for a longer period of time. Now, they don't necessarily lock them for free. There is costs that may be associated with that, but a lot of those costs are generally built into the price of the house. That's how MI, they can give greater discounts if you go through their financing arm, for example. They have a joint venture with MI Financial, MI Homes, MI Financial. They're kind of separate entities, but they have ownership within it. And so then they can provide special options for a client buying one of those homes. That's why you very rarely see anybody purchasing an MI or Pulte use outside financing. The only reason that somebody typically does is if, and I'm not picking on MI, but they have some things that are out of their wheelhouse, such as they may not have the best option if the client has challenged credit and they need to go FHA, or if it's a jumbo, they may have better options to obtain financing for a jumbo product elsewhere. So that's how an end loan typically works with the builder. They pick their product, they close on the loan once the house is complete. Then you have builders that they will either use an end loan or a construction loan. Those are custom builders, or I refer to them as semi-custom, because they do have options in place, but they can expand a little further than just your typical tract builder. And that might be a Bob Webb that is building in a subdivision that they own all the land for. And Bob Webb, they'll build anywhere. They don't just build in their subdivision. If you have a piece of property,
Oh, no.
in Romanelli,
We're losing you.
you okay?
Slow.
You're losing
we
me?
got it. Yeah, you're back.
Okay. So like Bob Webb, Romanelli used retailer in Virginia, they will either do end loans or they will do construction loans. In this market, they prefer doing construction loans. That way they're not using their capital to fund the project themselves. but it's really case by case. And with these type of builders, you have many more options, but they will go either way, either the end loan or construction loan. Then you have the full-blown custom builders. That might be the Kevin Knight, the Jimenez Haid, Fallon, Schumacher, for example. And with them, they may own the land, but typically the client owns the land, and they will build a home, you know, basically to the customer's specifications from start to finish. And that's where it would be a full-blown construction loan.
Okay.
Does that make sense?
It makes sense to me. So, you know, what is the best way to kind of move through the process? I mean, let's say that I'm, you know, a FHA buyer and, you know, I've contracted with Schumacher because grandma's gifting me the land, and, you know, would I be wise to come to you and, you know, what the process would be? You know, grandma's given me these 5 acres and I want to build a house, but, you know, we're a VA buyer, say. What type of process would I go through in the application process to help my buyer build this house?
Yeah, so typically the first step is always getting them pre-approved, especially with somebody that is in the construction world. And your typical FHA and VA, the construction products that are available to them, it's not very common that I have anybody requesting the construction. Now that is the government construction is something that we don't do here. There are a couple people that do, but I talk to anybody to really find out, is that what I want? I had custom.
Hey, Joe, your bandwidth is really low. So you're kind of fading in and fading out. I'm not sure if there's something we can do about that. That's not your internet's weird.
Okay. Is that better? No.
It's still saying your network bandwidth is low.
Oh no.
It's time for Luca to build you that computer.
Sorry about that.
That's okay.
Yeah, I'm actually on the better yet?
Well, it's a little better. Does anyone have any questions for Joe? Because I'm not sure we're going to be able to.
I do, Lisa.
Okay.
So
Joe?
on the end loan, Joe, for production, say a production builder like MI or Dominion or who's now Pulte, does the production builder reduce the price to the buyer if the buyer chooses to use an outside lender outside of, say, MI Financial or something like that? He's completely frozen.
Yeah, he
Great
is.
question.
Oh,
Okay.
there we go.
Hello? Hello?
Yeah, we can hear you.
They typically will not offer the discount to an outside lender. Up in June, where I had a client, had them pre-approved months and months. He was actually moving here, and he asked me what I thought about MI, and I gave an endorsement, which helped him choose the budget, and they would not provide the discount. And of the sales rep that actually refers me business. Her arm, they would not budge, unfortunately. So,
Okay, so they almost tie you to having to use their lender. If you, yeah, okay. So my second question is lot loans. Does First Merchants do lot loans for purchase?
yes. Yes, we will.
And what is the criteria for a buyer?
Typically 30 to 35% down is what is required.
Is there
And
any?
typically it's a standard.
Go ahead.
What's that?
Go ahead.
So 30 to 35% down, and it's typically a fixed rate. However, we can get an
Hey, Joe, shut your camera off
Yes.
and see if that helps. We'll just look at a blank screen. That might help with the bandwidth. There we go.
Hello?
That's better.
Is it? Okay.
Can you go over that again, the 30 to 35% down? And what are the terms, you know, years, that type of thing? How's the interest rate like right now?
Yeah. So typically 30 to 35% down. The term can vary between a 5-year to a 15-year, and the rate's not great. It really just depends. It's going to be in the 6% range. However, we can sometimes get exceptions to do it as a line of credit with more favorable terms. Were you able to hear that okay?
Yes.
Okay, great.
I think it's hard to find lenders that will actually finance lots. So
Agreed.
it's good to hear that you do that.
Yeah, typically the lot loan is not the preference. If we can find other ways to finance it, it's typically better just because the terms aren't great. But it's typically for a short period of time. You know, because we want them to build within a year. If we're doing a lot loan, we want them to begin construction within a year.
Okay, so so you do have that requirement in that type of mortgage that they have to start construction within a year?
They don't have to, that's the preference.
Okay,
We just don't want anything like hanging out there forever and they never build.
okay.
That makes sense. Does anyone else have any questions? No?
Yeah.
I don't see any hands.
Well, I do have one more question.
Sure.
Sorry. So with that lot loan, and you like construction to begin within 1 year, does the construction have to be with you or can it be with somebody else?
Well, we prefer the construction loan being with us. That's for
Okay.
sure. And typically if I have somebody in front of me, I've never had anybody not do the construction loan if they're gonna go through the lot loan process. Our terms are really good, and we didn't even touch on that yet. We have 3 different products that we use for our construction loan. The first one that is available to just about anybody, it's a 7-year ARM. Okay, it's not a 30-year fixed. We can refinance it to a fixed afterwards typically, but the 7-year ARM, it's interest only during construction. The rate is only 2.625. It's fixed that whole year at 2.625 interest only. Once the house is completed, then the 7 years actually begins. So the rate will be 2.625 for the next 7 years. After the 7 years is over, it then will roll, and it can change one time per year after that. So today, that rate is 2.625. Now, the best option that we have right now, this product is designed for what we would refer to as our private banking client. It's a 15-year ARM, okay? So that means the rate is fixed for 15 years, but it's amortized over 30 years. So it's not amortized over 15 where the, and so is only 2.375. This product is actually not just for our construction, but we could use this for a jumbo. We can use it for a regular conventional loan as long as they meet the private banking qualification. And what that is, can you hear me okay? I'm getting an unstable mark.
Yeah, we're hearing you.
Okay. Also, dollars, for example, they have to go over 180,000 in annual income and have 250,000 in investable assets.
We're kind of losing you, Joe. We kind of lost you there.
I'm sorry.
That's okay. Hey, Joe, real quick, I think we probably are playing with the internet gods, and it's Mercury retrograde. How can people get in touch with you? Is it okay if I pass your name along in the chat, and that way people can reach out directly to you if they have somebody who might fit that qualification or have any other lending questions that you might be able to answer for them?
Yeah. Please pass on.
Sorry, guys.
Hello.
Hi.
I'm sorry.
No worries.
Hang on 1 minute. I'm going to try one more thing. I hope I don't.
I don't think this is working. I'm going to put in the chat
Hello.
box. Hi.
Hi, how's that?
Better.
Is it?
Yeah.
Okay. Yeah, so give my name and number, and if you wouldn't mind emailing me everybody's email address, and we'll send out a package. And I'm very easy to reach as well. Just my cell phone, 614-309-3992. I'm very easy to reach, even if you just want to consult, because right now what we're seeing is sometimes people don't know what they want to do because of the market. Do they want to build? Do they want to buy? Do they want to stay where they're at? So I am more than happy to, consult with anybody.
Okay, perfect. Well, Joe, we really appreciate you and being part of our brown bag lunch series and builder series. And if anybody has any questions, I'm just finishing typing up his email and phone number in the chat box, so you'll all have it. And we really appreciate you coming out to help us today.
Oh, you're very welcome. Hey, can I just make one more point?
Sure.
Yeah. So a lot of banks with the appraisal world right now, it can be quite challenging getting appraisers out, getting a timely report, getting an appraisal done as the opinion as accurate as possible. We don't have an appraisal management company. We don't use one. We do our appraisal management internally. And that's a big deal. And so if you have something where you have concerns about appraisal service, it's not perfect just because appraisers are overwhelmed right now. But being able to manage the appraisal process internally is huge. and our rates are really good and we close on time. We don't like to put a 21-day closing in the contract. All right, we like it to say 30 days or less. But if you're in a jam, we can really get loans closed very quickly. So just keep that in the back of your mind as well.
All right, will do.
All right, well, thank you all.
Thanks. Sorry we had technical difficulties, everybody. Hopefully you
Me-
learned something.
All right.
I know I did.
All right. Thank you.
Thanks.
Thank you,
Bye.
Joe, and thank you, Lisa.
Bye, Jeff.